Let's jump back into the oil patch with another trade in the integrateds. I'm Jill Malandrino with TheStreet's Options Profits.
And I'm Scott Redler, Chief Strategic Officer of T3Live.com.
Before we get into our trade for the day, let's take a look at the overall space with OIH.
The reason why I like this chart pattern right now is it's in the anticipation mode, but traders right now are getting really chopped up trying to buy momentum, trying to buy a stock higher for it to go higher because it's just not, it's not in the cards right now. So the inverted head and shoulders pattern on the OIH is an accumulation pattern. It's an anticipation pattern of a better move at some point this year. So if you look at the chart right here, you will see this is the pattern. Here's your left shoulder, here's your head, and here's your right shoulder. So this is what I would say your tier 1 level should be, that if you want to have a thesis of buying the OIHs into next year, you buy long around 115 or so versus the 110 or even versus 108. And then if it starts to work going through first quarter 2012, you could add above this mini downtrend, which is around 125, and then the pattern is complete with a close above 131, which is the neckline, and then from the distance from the head to the neckline is about 30 points. And if this is a 2012 theme that works out, you could see about 160 in the OIHs, during that time period.
So a couple Thursdays ago, we got into a trade with ConocoPhillips. I love that company. It has a strong cash position. Management is firing on all cylinders. That Friday after our call, they announced a $10 billion share buyback, so completely lends to the thesis that we were following for that trade. Today I want to take a look at Chevron for a different story, although it's still within the integrated space. This is a production growth story. It's different than ExxonMobil, which is a giant cash cow. How much bigger can it get? Chevron is expected to grow earnings 30% year over year, yields a nice 3.14% dividend yield, which is actually a full percent higher than ExxonMobil. So we like this for a little bit longer term than we did the Conoco trade. Let's take a look at the chart.
That sounds interesting on a fundamental basis because on the chart it has some tradable patterns as well. If we're going to see a little weakness, we have a level to trade it against. And then if we get momentum, I see another one. So at the chart right here of CVX, you'll see you have this downtrend that's been in place since the highs of October. It still can't get through it like the market. It did come off the moving averages yesterday, so it's showing relative strength. I think you get into a comfortable tier 1 somewhere in this area, and hopefully it holds the gap that it had from November 30th, and it's still in there. And then if it starts to get above this downtrend, maybe above 104, you could see a momentum move. So tier 1 is in this area. Tier 2 is when it starts to break and close above this downtrend that has trapped this stock since October.
So from the options perspective, since we're a little longer dated and Skip Rashke of Options Profits is going to give us the actual number, you can look at a vertical call spread. It has a bullish bias. Take something out to like March, April, around that time frame, and you've got the controlled risk and reward profile.
There you go.
And don't forget, Options Profits viewers, don't forget that we have Scott's market wrap at the end of the day. We take a look at the charts and how action played out and setting us up for Wednesday's trade.